What's going on, traders? Welcome to the channel. I'm John. That's Groot. We're running out of time here. We trade options here. It's time to roll. It's time to roll. So I'm going to explain with expiration coming up how to roll your call options or put options, but this will be in AMC. You can see really quick, just want to talk about that trend line we set up on the previous video. You can see clearly it is a strong trend line. It's holding now as resistance. So this is going to be a key one to watch in the future as we move along. But let me dive into the nitty dirty details for you. I had closed out Tesla. That is profitable. It was like 80% in profit. That's great. Everything else I'm getting beat up on. So Roblox, I got time. This is for July expiration. We'll talk about that later, but GME is just a lottery ticket at this point. Almost a full loss. That's tomorrow. I'm gonna let this one ride out. So let's get to AMC. I want to talk about the important things. Now, rolling. Let's talk rolling, okay? The big question is, hey, there's 1 day left in this expiration cycle. For one, this is just a general guideline. Usually I don't like to hold till expiration unless I have to, okay? I know that sounds kind of weird, but for me it's a best practice to usually close out sooner. But with how much volatility was going on, with so much uncertainty, with the probabilities, I wanted to let them play out on Tesla and AMC and, trades like this, it was worth the wait, I guess you could say. So sort of like a one-off here, but let me explain how to roll. And you can do this, with 1 day until, you can do this tomorrow with 0 days left. You can do this a week out, a week till expiration. So keep that in mind. Now let's talk about rolling. The basic idea. What you do is you close out your existing, open a new one in the future. That's literally it. There's different ways to do it, but in essence, you close right now, you open up your contract for the future. And there's a lot of mechanics to it, but how I'll explain this, let's just use the 28 strike as an example. Let's say I'm like, okay, these are looking good, really, really profitable, but I want to keep the trade alive. And what I can do here is I'm going to go to trade. I'm going to go to let me clear that here. I'm going to go to the 28 strike on this expiration date. So here's the options chain. Here's 1 day remaining. So June 18th is the expiration cycle. Calls are on the left, puts are on the right, and let's go up the chain here to the 28 strikes. So that's right here. You can see I'm holding on to 3 contracts. Now, if I want to say just move this out to like next expiration cycle, let's just say I'm working with 1. So I'm going to hit the bid right here to sell. Right now it opened up for 3. I'm going to just change this to 1. So I've got 1 contract, and to explain this, I would get a credit from the broker. So if I want to close this right now, nothing else, I'm not going to roll or nothing, the broker would say, hey, John, I'm going to give you $3,395. To do this, if I was to close this strike here, just 1 contract right now, broker wants to give me $3,395. And what I can do is actually now I'm like, hey, broker, I want to go out in time. Let's keep this trade alive, baby. So what I'm going to do now is I just went back to the option chain, and I'm going to go to the 29 days remaining, July 16th, 2021. Let's go to the 28 strike. Okay. So I'm literally just doing a roll horizontal, no change. To do this, I would actually owe the broker money now. So it's saying, hey, you want to have more time in the trade, keep this alive, you got to pay me $135. It's a debit now. So that means you pay the broker to keep this open. Now, if you don't want to do that, there's something else you can do. It's called rolling out and up in this trade. So what I do, instead of just buying at the 28 strike, how about I buy my contract 2 strikes higher at the 30? Now, this does a couple things. You notice what I owe is different, or what is owed. This is actually a $43 credit. It's 43 because it's 100 shares times 0.43. So that just gives you an idea here of what this is. And this is a credit the broker is going to pay me. Broker, what up? Broker's going to pay me money to do this. That's awesome. So what I can do is I can get 30 more days in trade, 29 to be specific here, and the broker pays me money, but I did give up $200 of intrinsic value. So in a way, I rolled out and up. I gave myself more time, but I did give up a little bit for it. I could split the difference, and now I just pay $45, but I did give up $100 of intrinsic value here from the 28 to the 29. So what this means is that if we get to expiration again, nothing changed. Maybe the stock's still trading at 62.25. We're at the same price. I lost $100 of value from the 28 to 29 strike. And then I also lost $45 by paying the broker. So that's kind of what you give up. Or if I go here, I gave up 200 actually from 28 to 30. Broker paid me $43. So that just gives you an idea of how to roll your options. Where I'm at, I'm going to give some updates as I move along, but I definitely want to keep the play alive. I think my out of the money stuff, I'm either just going to let ride out as a lotto ticket. I may close these ones, and then I may exercise here. I want to have maybe 300 shares in AMC for selfish reasons. I want to help the movement for one, right, by having ownership in shares. But then two, you can actually get really, really good income from covered calls. And so that may be something coming up here in the future that I'm happy to present to you guys, kind of help you understand how to make those trades. But I hope that helps. Drop a like. We got to get this message out. And let me know, are you rolling your contracts? What contracts do you have? Just be aware, keep your risk in check. Not financial advice. See ya.